For 9 weeks straight, this market did nothing but go up. 9 weeks. That's the longest winning streak in years. Records on the Dow, records on the S&P, the AI trade looked unstoppable. Last week, that ended. The S&P just had its first losing week in 10 weeks, and it did not end quietly. On Friday alone, the Nasdaq dropped more than 4%, the worst single day in over a year. The chip stocks that led this entire rally got destroyed. Marvell, Micron, AMD, Intel, Nvidia, all of them got punished. So if you're feeling a little shaken heading into next week, you're not alone. But here is the thing. Last week was not random. It told a clear story, and there are real lessons in it for how you trade going forward. So let me walk you through 3 things in this video. Number 1, what actually happened and in what order. Number 2, why the streak finally broke. And most importantly, number 3, what you need to pay attention to heading into the next week, because there is a very important news event happening which you need to know that could dictate if this market continues to sell off or it bounces back. So let's get into it. First, let me walk you through how last week actually unfolded, because the order matters. Monday and Tuesday, it was business as usual. The AI trade was still running. The S&P actually closed above 7,600 for the first time ever on Tuesday. The chip boom looked completely intact. Nobody was worried. Then Wednesday night, Broadcom reported earnings, and this is where the week turned. Now, Broadcom is one of the biggest AI chip companies in the world. Their numbers were actually fine, record sales, but they did not raise their AI forecast for the year. They just left it the same. And we have talked about this before. The market does not trade on good or bad. It trades on better or worse than expected. Everyone expected Broadcom to come out and raise their bar. When they just held it steady, the market treated it like a disappointment. The stock fell more than 10%. Hundreds of billions of dollars gone. The chip stocks kept falling, but the Dow actually hit a record high. Why? Because money was rotating. It was leaving the expensive AI names and moving into healthcare, financials, the boring stuff. So on the surface, Dow looked great, even while the AI trade was quietly breaking underneath. And then Friday, the whole thing cracked. So why did it crack on Friday? 2 things hit at the same time. The first was that the Broadcom fear was still spreading. Once the AI leader disappoints, traders start asking if the entire AI trade has gotten ahead of itself. So the selling spread to every chip name. And the second thing was the jobs report. Friday morning, we found out the economy added 172,000 jobs in May. They were expecting less than half of that, a huge beat. Now, you would think a strong economy is good news, but here is the twist that catches so many new traders. A strong economy means inflation stays a problem, and that means the Federal Reserve is not going to cut interest rates. In fact, after the report, the market is now betting that the Fed might raise them by the end of the year. And higher rates are poison for exactly these kind of expensive high-flying growth stocks. So put it this way, the AI leader disappointed and a hot jobs report killed the hope of rate cuts in the same week. That was 1-2 punch in what finally ended the streak. Now, here's the part I really want you to understand, because this is the lesson of the whole week. This did not come out of nowhere. For weeks, these AI and chip stocks went almost straight up. Micron tripled in months. The whole group went vertical. And when stocks go up that fast, that far, they get stretched. They get priced for perfection. And when something is priced for perfection, you do not even need bad news to bring it down. You just need anything less than perfect. This is exactly what happened. Broadcom did not give bad news. They gave good news that was not good enough. And because the stock was priced for perfection, that was all really it took. This is why we always talk about not chasing things after they have gone vertical. Not because the companies are bad, but because when expectations get that high, the risk is enormous and the reward is small. The people who get hurt last week were the ones who chased these names at the very top, right before the air came out. So, what does this set up for the week ahead? It really comes down to one thing: interest rates. Here's what you have to understand. This entire sell-off was not really about Broadcom. Broadcom was the spark, but the real fuel was interest rates. For months, this market ran on one big hope: that inflation would cool down and the Federal Reserve would start cutting rates. Lower rates are like fuel for stocks, especially the expensive, high-flying tech names. So as long as everyone believed cuts were coming or were gonna stay steady, the market kept climbing. Then Friday jobs report came in so hot that hope took a serious hit. A strong economy means inflation stays a problem. And that means the Fed is not cutting. In fact, people are now betting they might even raise rates. And that is the real reason tech got hammered. Higher interest rates are poison for exactly these kind of stocks. So going into this week, forget the noise. Watch interest rates, watch the bond market. The 10-year yield is the number to keep your eyes on. If yields keep climbing this week, the pressure on tech stays, and this sell-off probably is not done. But if yields settle down, tech can finally catch its breath. So before I tell you how I'm approaching this week, you need to know what is coming. And the best way I can describe it is like waiting for a verdict. All last week, the market was on trial for one thing: the fear that inflation is too hot and the Fed will not cut rates. Friday's job report was a witness for the prosecution. It made the case worse. This week, we get the inflation report, the CPI, and that is the verdict. If inflation comes in hot, the market is guilty. It confirms everything the bears have been saying. Rates stay high, the pressure continues, and this sell-off probably is not over. But if inflation comes in soft, cooler than expected, the market gets off. The whole fear that drove last week starts to look overblown, and a nervous market breathes a huge sigh of relief. Same market, two completely different futures, and we find out which one when that number drops on Wednesday. So, going into the next week, I'm not in a rush, and let me tell you why, with something I learned the hard way. Early in my trading, I used to think a big down day was a gift. the stock I wanted was suddenly 20% cheaper. So I would jump in fast before it bounced, before I missed the bargain. And I would get run over again and again. Because what I did not understand back then is that when something is falling this hard, 20% cheaper can become 40% cheaper in a hurry. I was not buying a bargain, I was catching a falling knife. The traders who actually make money after a week like we had last week are not the ones who rush on Monday morning. They are the ones who wait. They let the selling exhaust itself. They let the dust settle. And then when things calm down, they buy with a clear head. Cash is a position. Patience is a position. If this helped you make sense of a rough week, please subscribe. I do this every week, clear and honest, without the hype and without the fear mongering. Take care of your accounts, and I'll see you in the next one. Bye for now.